Morning, everybody. It's Mike. Happy Monday morning. Hopefully you had a good weekend and a fresh start to the week here. So, as usual, this is your best time to get run things by us, tell us what's working well, what's working poorly. If you've got questions or problems with the systems, or you have hurdles come over, if you've got those problems, so did everybody else. So this is a great time to discuss those. We obviously do always have a topic to discover or to cover, and this is a very, very important topic to cover, and because in the environment we're in right now, a lot of people have moved their money to bonds, and bonds are probably one of the worst places, besides variable annuities, you can move your money to right now. So, Misty, do we have any questions coming in before we start on our topic?
We just have one kind of general one. Is the implementation meeting where accounts are moved, documents signed, or is that another meeting?
Okay, that's a good question. Oh, and then I'm sorry, while I'm answering that question, Jeff and I are answering that question. Jeff is going to be presenting the presentation on bonds, and he'd like a couple of volunteers. So, Misty, if we could get some people to raise their hands. And guys, the call goes a lot better if we can have a couple of guys who are willing to bounce back and forth with Jeff. You're not going to ask him any hard questions. It's just a way to make the call more interactive, and I think everybody gets a lot more out of it, especially the people who volunteer. So if anybody's willing to do that, please raise your hand so that Jeff can bounce some things back and forth with you. That would be really helpful. So while we're waiting for that, is the implementation the meeting where you would move and sign accounts? Yes. So your first meeting is to get them to commit to that they'll move their money to you if there's lots of problems. The second meeting is to get them to not like their advisor, but we do not provide any solutions there. So the third meeting, the implementation meeting, is where we, again, review to make sure they still do not like their guy. And once they've committed to that, we ask them, would you like me to show you what most of my clients do? And they'll say yes, and that's where we will show it to them, and that's also where we'll sign the paperwork. Now, if they're not ready to sign the paperwork at that meeting, after you show them everything, and again, we don't want to get to that point, but if that does happen, then you're going to need to go to another meeting. So I would say, I don't know, Jeff, what would you say? Would you say it's about 75-25 they sign at the third meeting, and then some people have to roll to the fourth meeting, or what would you say?
Yeah, I'd say it's about 75-25. The guys that roll to a fourth meeting, the guys that I've talked to that roll to a fourth meeting, generally set it up that way in advance. Mm-hmm. So they probably could. It could be 100% at the third meeting, but they just tell them, I'll have my assistant prepare the paperwork and
then come in for that.
Yeah.
Because it does take a while to fill out paperwork for some particular circumstances. So any more? Did that help, Michael? I can't see the dashboard, so did that get Michael's question answered?
I think so, and I do have a couple of volunteers. So, Eric, I've just unmuted your line, and Michael, I've unmuted your line, so we can ask you if that answered your question too.
And then I'm gonna mute myself because there's gonna be some background noise here. So I'll be listening in.
Perfect.
So thanks Jeff for taking the call, and I'll probably chirp in here at the end.
Okay, let's see. We've got Eric.
Yeah, and there's
a lot of background noise there.
Okay, Michael.
Yeah, there's a lot of background.
Yeah.
I'm trying to figure out who's who. Okay. I think there might be quite a lot of background noise coming from Michael's line. Eric, can you speak?
Hi, I'm here. Hello?
Yeah, actually, I think it might be Eric.
Let's see. Okay, I just muted Eric. Michael, go ahead and speak.
Everything in Utah is just fine.
Oh, no, let's see, Michael.
Okay. I think we might actually have background in both of them. So.
Well, we'll see. We'll see how it goes.
Okay.
I mean, if there's too much background noise, we might have to mute you, Michael. But otherwise,
Let me turn the air conditioner off. That might help.
Okay.
Well, let's go ahead as he's doing that and start out with today's pointer. And you guys know that the markets were really brutal in 2008 and 2009, and there's been a lot talked about how that's affected investors going forward. So I just kind of want to throw some numbers out from a couple of magazine articles to kind of show just how hard it's hit people. The headlines are generally, people are out there seeking less volatility in their portfolio. And the bear markets of 2008 and 2009 hit pre-retirees and retirees' portfolios hard. Although the broad equity market indices have since recovered, older investors remain cautious about risk-taking, according to a study by Prudential. It's called Changing Attitudes About Retirement Income, Tracking the Challenges of Investors in the Retirement Red Zone. And they're studying that time period between 2006 to 2011. And it says the results highlight a post-bear market shift to a more conservative attitude among investors close to retirement or recently retired. So the people that we work with are thinking differently these days. So what are they thinking? Well, 68% say, the majority, that they're more cautious now than ever before. And 47% say they hesitate to invest more in the market despite future growth opportunities. 48%, when it comes to the future, we don't know what to expect. And in 2009, 68% said that they just were seeking less volatility from their portfolio. So here's the thing. Here's how this can help us, and here's how it can kind of be, every coin has two sides, so that's the downside to things. People are a lot more cautious than they've ever been in the past. But here's what they're also saying. Another finding that has positive marketing implications for financial advisors. When asked specifically about the help they need in retirement income planning, half the respondents say they need guidance on the financial issues they should be thinking about and the solutions that may be best for their situation. So while people are a lot more cautious, they're also a lot more open to seeking advice. Because they know they can't keep doing things the way they've done them in the past. And they're looking for people who can show them something different. And I think what that means for us is, if we're out there marketing, this is a great opportunity for us. Because people are scared, people are cautious, people are worried, people are open to advice. They want to see what's out there that might help them and might be a little bit different than what they're doing now, because they don't think they can keep doing what they're doing, or they just want to, they think the world has changed and that they might need different advice. So like I said, if we're out there marketing, this is a great opportunity. And these things don't come along very often, where people are just actively searching and seeking advice. And we've probably been in the last year and a half, one of those periods where people are really out there looking for advice, really out there looking for alternatives and seeking out advisors in a way that they haven't in the past. So if you're marketing, this is a great opportunity for you. But if you're not marketing, guess what?
Missing the opportunity.
Yeah, you're missing the opportunity. It's not going to be any better for you than it was before. So I would tell you guys, get out there and market, because it hasn't been this good in terms of marketing in a long while. And this doesn't happen all the time. So get out there and market. Any questions before we move on to today's topic?
Jeff, outside of the epidemic marketing, any other things that we should be doing? Obviously, seminars starting back up in the fall, but...
Well, Mike talked about a lot of the things that you can do over the summer.
Yeah.
Ways to reach out to other professionals, ways to reach out to current clients, a little bit different ways to reach out to prospects, and we probably did that call, maybe 2-3 weeks ago, Missy?
Yep.
Yeah, I think it was 2 weeks ago.
Yep,
So
okay,
yeah,
that's enough.
Yeah,
Hey,
well,
not that I wasn't overwhelmed, but yeah.
Yeah, I think there were 6, 7, 8 things there. So, yeah, kind of pick and choose and find 2 or 3 or 4 that really fit you and what you're trying to do, and get that message out there. Because again, people are looking right now.
Okay.
So let's kind of talk about today's topic, which is bonds and bond mutual funds. And let's just spend a few minutes talking as advisors, and then we'll kind of bring our clients and their perspective into the discussion. So, Michael, let me ask you, from an advisor's perspective, or even from a client's perspective, how have the markets done the past 5 years? What kinds of things are you hearing right now?
A couple of things. People are really concerned about volatility in the equity markets. And the other perspective is investing in anything longer than about a 1-week bond has a lot of risk in it, because of the probability that that interest rates have nowhere to go but up because they're so low right now, and they've been maintained at such low levels by the Federal Reserve and the ECB, among others. And people are kind of sitting on a knife edge waiting for when this quantitative easing and the injection of reserves in the banking system.
Yeah. And I think that speaks to where people are right now. They're cautious, so they're not sure what to do, and so we have to be good. That's what the sales track is for. That's what the meeting process is for, to get people who are on the fence, who are ambivalent, to move forward. And that's what we do at the agreement meeting. That's what we do at the disclosure meeting. That's what we do at the implementation meeting. And if we're not good at that, you're right. They're going to continue to sit on the fence, so we have to be good at that. But if I ask people, or even a group of advisors, how have the markets done the last 5 years, what would they say?
Well, equities have been basically flat.
Okay, that's one answer right here.
And bonds,
Equities are, yeah, they've been flat. Markets have been flat.
bonds have done nothing but decline.
Okay, so equity markets have been
Well,
flat.
bonds is kind of complicated. You got two variables. You got the interest rate and you got the prices. Interest rates have gone down, which implies that the prices have gone up. But
Right. And the things that I hear are that, they're flat. I hear things like, well, they've gotten a lot better lately, because we have had that good run-up in the last couple of years. But those are the things I pretty much hear. They're kind of flat, maybe a little bit down, but, we've done pretty good the last few years. So, the answers are kind of across the board, depending on who you ask and what their perspective is. And really, as advisors, we know the answer to the question, how have the markets done the last 5 years, is it depends. Depends on what market you're talking about. So let me throw some numbers out at you guys, and let's see, if we look at the markets, kind of what the tail of the numbers is. If we look at just the broad U.S. equity market, something like the S&P 500, down 0.04%. So, like you said, flat. Pretty much, level, flat. They haven't done anything the last 5 years. How about absolute return? Because those were some popular strategies when everything started to tank. People started saying, well, let's get some tactical managers. Let's do some absolute return strategies. And they really grew in the last several years. So how have they done the last 5 years? Down 3.72. You hear a lot about hedge funds these days. So what about hedge funds? How have they done the last 5 years? Down 8.89. People talk about emerging markets and the need to be maybe outside the U.S. Down 18.87 the last 5 years. And then, Michael, you mentioned bonds. So if we look at something like the Barclay Aggregate Bond Index, up 12.84. Long U.S. Treasury, and when I say long U.S. Treasury, I mean 30-year maturities, up 29.93. And then if we look at just kind of an all-cap world index, the MSCI all-cap world index, down 13.33. So guys, look at those for a second, and then let me ask you, do any of those jump out at you? Anything look better than maybe the others?
Long Treasury.
Yeah. I'd say long Treasury looks good, doesn't it? And even aggregate bond doesn't look bad, especially when you compare it to all those other numbers. So here's a question. The bonds have done well. And so is the smart money on bonds these days? And to kind of answer that, we have to look at why bonds get valued the way they do. And there are really 4 things you have to consider when valuing or pricing bonds. So those 4 things are interest rates, supply and demand, and we'll spend some time talking about supply and demand because I don't think that gets talked about an awful lot. Inflation. And these 3 factors affect the value of all bonds of all types. And they can be a headwind or they can be a tailwind. And when I say they can be a headwind, what do you think I mean by that? If I say inflation or supply and demand or interest rates can be a headwind to bonds, what do you think I'm saying when I say that? What do you think I mean? Maybe we lost everybody.
Well, I don't quite get what you're getting. Headwind and what's
Tailwind. So if bonds face a headwind, what would you say that statement means?
I would say
They're in for tough times.
Yeah, they're in for tough times. Or if bonds have a tailwind, what do you think that means?
They're selling at a premium right now.
Yeah, they're doing good. It's looking good. Headwind means it's looking a little tough. Tailwind means, they've got the wind at their back. Should be doing pretty good. Headwind would mean, well, they got their wind in their face. It's going to be a long, hard road, maybe even knock them back a little bit. And so interest rates can be a headwind or they can be a tailwind. They can be good for bonds too. Supply and demand, that can be bad for bonds or it can be good for bonds. Inflation can be bad for bonds or it can be good for bonds depending on where we sit with those things. So we'll talk about these things and their headwinds or their tailwinds. They're not always bad. They can be good. And the fourth factor, said there were four things. The fourth factor is really the credit quality of the bond issuer, and it only affects some bonds, and those are the ones that get issued by companies or entities with bad credit. But that's always a headwind. That's never good for bonds. Bad credit never helps. It only hurts. So we're going to focus our discussion today on the things that can not only hurt bonds, but also help bonds as well. So let's start with interest rates. So I want to read a quote from an April 2012, so just a couple months ago, article from USA Today. And they were really talking about why long treasuries have done so well, why treasury funds have done so well over the last few years. But they could be talking about any bond. So in this case, they're talking about treasury funds, but for our purposes, they could be talking about any bond or bond fund. So it says bonds are IOUs that pay regular interest until they mature, and then investors get their money back. But much of the government bond fund's returns are from price appreciation, not income. Of the 44% total return the past 5 years for treasury funds, half was share price gains, Lipper says. The reason, when interest rates on newly issued bonds fall, so when interest rates go down, bond traders bid up the price of existing bonds with higher rates. So here's the first thing to notice, that interest rates and bond values are connected. The article is making the point, and a lot of financial advisors already know this, that interest rates and bonds act opposite of each other. So just like they said, when interest rates are low, what happens to bond values?
Well,
Yeah, they go up. And where have interest rates been the last 5 years?
historic lows.
Yeah, they've been real low, which means bond values went up. See why they make the point of saying it's price appreciation, that's why these funds are doing so well. It's not like the bonds are issuing more interest or paying more dividends. It's actually the fact that the price of the bonds is skyrocketing because interest rates are so low. That's why these funds have done so well. So the last 5 years, when interest rates were low, have interest rates been a headwind or a tailwind for bonds?
headwind.
No, they've actually been a tailwind. Yeah. They've actually helped bonds because low rates mean what to the value of bonds?
High prices.
High prices. That's why these funds have done so well. That's why when we looked at those numbers, Barclay aggregate bond was 13% up in a world when everything else had been down or flat. Long Treasury had been up in a world where everything else had been down or flat. And that's because interest rates were low, driving bond values up. They've been a tailwind. So if you had bonds during the last 5 years, were you happy?
Sure.
Yeah, you were happy. But where are interest rates now, Eric? I think you said it.
They keep finding new lows. Soon
Yeah.
to be negative.
Yeah. In fact, the article says interest rates are already near historic lows. So what should we expect going forward?
Got nowhere to go.
Yeah, but which direction?
But
Up. And if they go up, what will happen to bond values?
gonna go down.
Yeah.
Yeah, they're going to go down. Here's another concern that the article pointed out, and it's not commonly talked about, and that is that the end of Operation Twist, the Federal Reserve's program of buying long-term bonds to keep rates low, should end in June. So that should end this month. So without it, Treasury yields could rise and prices fall. What they're saying is the Fed has been trying to keep interest rates artificially low by jumping into the bond market and being this big eater of demand, buying them even when interest rates are low to kind of keep the prices low. Otherwise, they tick up. And they're going to end that program, and when they do, what we could see is interest rates do what?
Back up.
Yep, and if they start going up, what will the value of bonds do?
Go down.
Back
Yeah.
down.
So interest rates the last 5 years have been a tailwind. They've actually helped drive bond values up. But what do you think they'll be going forward?
They're gonna have to go up.
Yeah, which means there'll be a headwind, something that we'll have to watch, because when they do go up, what's going to happen to the value of bonds?
Gonna go down.
Yeah, going to go down. Let's look at the next kind of issue that we could talk about. That's interest rates. And that is supply and demand. So let's do a little Econ 101. Let's kind of look at the basics of economics. And a lot of the basics of supply and demand is really kind of the foundation of a lot of economics. So start by the premise that over-demand drives prices up. And so if you have 10 Beanie Babies and 1,000 people want them, what happens to the value of Beanie Babies?
Price goes up
Yeah, why?
because there's more people demanding them than there is available supply.
Right. So over-demand drives prices up. Okay, that's a no-brainer. That's simple economics. Oversupply drives prices down. So let's reverse it. Let's say we have 1,000 Beanie Babies and only 10 people want them. What happens to the price of Beanie Babies?
Go way down.
Yeah, they go way down. Anybody that wants a Beanie Baby can have one, right? They're not going to pay a lot for it because they know there are more Beanie Babies than there are people who want them. So that's just basic economics. Over-demand drives prices up. Oversupply drives prices down. So QE1 and QE2, they aren't cruise ships. QE1 and QE2 aren't cruise ships. What are they? Well, they were...
Well, it stands for quantitative easing, which was the Fed's policy of moving short-term interest rates basically to zero.
Mm-hmm.
And Operation Twisting was fairly recent when they were trying to flatten out the yield curve, basically.
Yep. And really what quantitative easing 1 and 2 were, where they were... See, the economy was stalled in 2008. And the Fed says, oh my goodness, what can we do? You know, we're in a tailspin here. What we need to do is put cash in people's hands so that they can go out and buy cars and refrigerators and go on vacations and spend money in restaurants and at hotels. See, people don't have cash. So what we need to do is put cash in people's hands. Well, how can we do that? Well, let's go out and buy bonds. We'll take people's bonds off their hands, and in exchange for those bonds, we'll give them cash. Cash that they can spend at restaurants and hotels and buy new cars and refrigerators, and that will hopefully jumpstart the economy. And so they bought, over the course of QE1 and QE2, $600 billion worth of bonds and replace them with $600 billion in cash to jumpstart the economy. But they were buying and buying and buying $600 million worth of bonds. That created an over-demand for bonds. So was supply and demand a headwind or a tailwind for bonds?
Tailwind.
Yeah, tailwind. And if you owned bonds during that time, were you happy?
Making a killing.
Yeah, you're making a killing. That's why when we looked at those numbers, those bond funds had done so well. But some critics said that, you know, if you put that much cash into the economy, you know what we're going to end up with down the road?
Inflation.
A lot of inflation. Shouldn't we be worried about that? And guess what the Fed said?
Nope.
Don't worry. We're not going to keep these bonds. We're going to sell them all back. So at some point in the next few years, they're going to sell back $600 billion worth of bonds to take that cash back out of the economy. And that's going to create an oversupply. So with supply and demand, it was a tailwind, but going forward, what should we expect?
Headwind.
A headwind. Notice we've got interest rates that were a tailwind now becoming a headwind. We've got supply and demand that were a tailwind becoming a headwind.
The problem, though, is you don't know when the Fed is going to reverse, make that decision. You're going to reverse it. So.
Yeah, and hold that thought, because we are going to talk about that here in a little bit. Remind me that we don't know when they're going to do that. We are going to talk about that. So if we don't cover that, remind me. The last thing we need to look at is inflation. Now, what's inflation been like the last 5 years?
Pretty benign.
Yeah, that's good. Because according to USA Today, although the government's main gauge of inflation, the Consumer Price Index, has been relatively tame, investors worry that today's rock-bottom interest rates could spur a bout of inflation. Bond traders view inflation the same way Superman views kryptonite. Inflation erodes the value of a bond's fixed interest payments. When traders think inflation is in the air, they bid bond prices down and yields up. Okay? So, little to no inflation. Is that a headwind or a tailwind to bonds?
Headwind.
No inflation is a tailwind.
Oh,
So
no
we don't-
inflation.
Yeah, no inflation is a tailwind. So over the last 5 years, if you were a bondholder, were you happy that inflation was benign?
Absolutely.
Yeah, you were really happy. What did that do for the prices of your bonds?
Drove them up.
Drove them up. But more inflation, like the article says, will turn that tailwind into a headwind. And this is a good illustration of why and what kind of a headwind we could be talking about. So this is the effective inflation on a $100 bond. And so here's what it's saying. If you put $100 into a bond and you had 3% that paid 3%, that $100 bond would pay $3 in interest. Okay? Now, if we add to that and we said, well, there's 3% inflation a year, then the next year that $100 bond would only be able to buy $97 worth of stuff. Okay, because inflation would eat into 3% of that. And then your $3 interest payment would only be able to buy $2.91 worth of stuff. If we had 3% inflation after 2 years, your $100 would only be able to buy $94 worth of stuff. And your $3 of interest would only be able to buy $2.82 worth of stuff. Guys follow that chart?
Mm-hmm.
So that after 6 years, our $100 bond might only be worth $83. And our interest could only buy $2.50 worth of stuff. You see how inflation eats into the value of bonds. And for these reasons, Warren Buffett says bonds are no good. And that as European tensions unfold, he planned to stay away from medium or long-term bonds, our own or other countries. Now this is something he said May 5th, 2012 at a Berkshire Hathaway shareholder meeting. So was that long ago?
Nope.
No. He says bonds are a terrible play, and I have no intention of getting into bonds going forward. Not U.S. bonds, not any other country's bonds. It's something that they're no good right now. And he's basing those comments on the obvious things that we've just looked at. I mean, what will interest rates inevitably do?
Go up.
Yeah. And that'll be a headwind for bonds. And when the Fed inevitably reverses QE1 and QE2, creating an oversupply, what will happen to bond values? They'll go down. That's an additional headwind for bonds. And can we plan for 0% inflation over the next few years?
No.
No. We have to plan that inflation will be a headwind going forward. So notice, all the stars lined up for bonds in the past, but now all the stars are lined against bonds. I mean, if these end up being headwinds, will that be good or bad for bonds going forward?
Bad.
Bad. And that's why Bill Gross is the head of PIMCO. And they're probably the most recognized bond traders and bond investors in the world. He's really thought of as the foremost expert on bonds. And when he talks about bonds, people listen. And here's what Bill Gross says. He says a SAMI scheme, and that's what he calls a Ponzi scheme that's perpetuated or initiated by the federal government, a SAMI scheme, Uncle Sam. He says a SAMI scheme is temporarily, but not ultimately, a bondholder's friend. It raises bond prices to create the illusion of high annual returns, but ultimately it reaches a dead end where those prices can no longer go up. Anyone for 1.1% 5-year treasuries? Well, the Fed will buy them, but then what? And how will PIMCO tell the $500 billion investor dollars in the total return strategy that the Thanksgiving Day axe has finally arrived? So does that sound like he's bullish on bonds or bearish?
Bearish.
Yeah, bearish.
Very much.
Now, Michael brought up a good point. Do we know when these things will happen? Do we know when inflation will go up? Do we know when interest rates will go up? Do we know when the Fed is going to sell the bonds that they bought during QE1 and QE2? Do we know that?
No.
And do we know the order in which it will happen?
No.
Yep.
No, we don't. But notice the conversation isn't if these things will happen, but when. And if the conversation isn't if, but when, what should you do?
Act.
Yeah, act.
Well, you should avoid being in a position where you know you will eventually be screwed by the markets, or put your clients in that type of position, which means keeping them out of new bonds now and keeping them very, very short.
Yeah, very short.
There's a difference between whether you are entering the bond market now or whether you owned bonds in the past.
True, but let's do this. Should we be creating bond positions or adding to them right now?
No, that's what I'm getting at.
Yeah, absolutely not.
And it's not really the actual rate of inflation that drives bond prices. It's the market's expectation of the future rate of inflation.
Right.
And that in itself can be a probability distribution, and different investors have different expectations.
And it isn't just inflation, right, Michael?
Oh, absolutely. There's a whole bunch of
It's
things.
supply and demand. And what else?
Everything else that we've talked about, but because it's based on expectations of inflation, nobody precisely, it's not the current rate of inflation as reported by the Department of Commerce. It's what investors expect the future rate of inflation to be, and nobody knows what that number is, really, unless you interpret it from actual prices and the actual tradable security.
Yep. So Michael brings up a good point. It could be even worse than we think. Because we could still have low interest rates and low inflation for a while, but people's expectation might still drive prices down. So it could get from bad to worse depending on expectations. And like we talked about in the pointer, people's expectations, are they generally positive about the future or a little bit shady and negative?
Well, I think they're negative.
Yeah. So, like you said, Michael, it could be even worse than we say. Now, to the average investor, this is all foreign and new. So you can't necessarily talk to them about these things the same way that I talk to you. So then the question becomes, well, how do you talk to potential clients about bonds that they might have in their portfolio? Because you'll see people coming in with bonds, and guess what they'll tell you? Man, these things have done great the last few years. And have they?
Yeah.
Yep, because interest rates were low. The Fed was creating an overdemand. And inflation was low. And Bill Gross says, well, that created an artificial bond bubble. Now, what do we know about bubbles? What have we learned about bubbles over the last 10 years?
I'd say over the last 400 years, they always break.
Yeah, they always pop, and when they pop, do you want to be there?
No.
Do you want to be in real estate when the real estate bubble bursts?
Nope.
Do you want tech stocks when the tech stock bubble bursts?
Nope.
Do you want to be in bonds when the bond bubble bursts?
Nope.
Or tulip bulbs, for that matter.
Yep, or tulip bulbs. You don't want to be there. So use the proposal to talk to these things about, to talk to your clients about bonds or your prospects about bonds, and use the diagrams inside. Because we can make the mistake, this is not necessary, like we talked about, our clients don't think about these things every day. And so we can make the mistake when we're trying to explain it of talking too much. See, we know what's going on, but who needs to know what's going on?
Client.
Yeah, the client. And so we can say it, but who needs to say it?
Client needs to say it.
Yeah, the client needs to say it. So the only way for them to say it is to have the discussion that's on the website and use the proposal and the diagrams inside the proposal to get them to make the point. Now, it's all on the website. So if you go to the website and you click on the disclosure meeting, you'd go to part 12. That's called interest rate volatility. So it's not going to say bonds. It's going to say interest rate volatility. And the reason is, like we talked about, bonds and interest rates act opposite of each other. So if interest rates go down, bond values go up. If interest rates go up, bond values go down. And there's a script there for covering this with your clients. So what I'd like to do is kind of briefly, and Eric, maybe I could use you as to role play this. Would that be okay?
Okay.
And all you have to do is be the client, or be the client.
Hey, Jeff, can I just jump in? And you did touch on this, but I just wanted
Sure.
to... Am I still there? Do you hear me?
Yep.
Okay.
We can hear you.
You did point this out, but I just want to be overly clear that what Jeff just went through was for you guys only. Do not attempt to explain those things to the client. Do they need to know all of that stuff that you guys just went through?
No.
No. So it's for your use only. But guess what advisors love to do? Show how smart they are. So guess what we love to do? Go through all of this stuff, and pretty soon, guess what starts to happen? When you overwhelm people with information, guess what they do?
Shut down.
Shut
Lazy.
down. And Eric, when they shut down, that means they're not going to do what?
Not going to buy.
Not going to buy. So what Jeff is about to show you is all the client needs to know. It's boiled down to, hey, bonds in this particular environment are extremely dangerous. the stuff Jeff just went over was for your guys' benefit only, to let you guys know that bonds are dangerous on any number of levels right now. But please don't go through all that stuff with the client. Boil it down to what Jeff's about to go through, okay? Thanks, Jeff.
And Jeff,
Okay.
a question came in from Casey.
Sure.
If you buy individual short-term investment grade bonds, the APY is priced in, and if you hold to maturity, wouldn't you take the potential principal loss out of the equation unless the company defaults?
Yeah, you would. But when and I guess my question to Casey would be this. What are short term? So yeah, I mean, if you're going to buy a 3-year, 4-year, 5-year bond, or you're going to be invested in a fund that has short-term maturities, well, let's talk about the bonds for let me.
It's hard to buy an individual bond of an individual
Yeah.
company in an amount less than $100,000. It's a practical matter.
Well, but it's possible. Let me touch on that afterward. Here's the 2 points, but I'll touch on it in more detail afterward. The point is, if they hold these individually, what are short-term rates right now? Like we talked about, 5-year treasuries are 1.1%. So is that a great rate of return? No. Are they going to lose that 1.1% interest, or are they going to be able to hold those bonds to maturity if they hold them for the entire 5-year period? Absolutely they can. But on an individual basis, you're not getting any rate of return.
You're paying $105 for a $100 bond when it matures, basically.
Right. And so that's not a great return. And if they hold it in a fund, the value of the fund is still going to fall. They can't hold it to maturity, I guess is my point, if they hold it in a fund. And we'll talk about that more in a second. Okay? So, Eric, you ready?
Sure, go ahead.
So let's say Eric has some bond funds. That's what you're going to see most typical. But we can talk if he held individual bonds. And so I would tell Eric, the next thing we need to talk about is you may be exposed to interest rate volatility. So let's look at that for a moment. You've got some bond funds, and bond funds are good investments. There are a lot of good reasons to have bonds. So guys, the first thing I'm going to do is talk about all the positives of bonds. I'm going to get on his side. So bonds are really good investments, and there are a lot of good reasons to have them. And generally speaking, why do people invest in bonds?
That gives me that monthly yield that I need to live.
Yeah, they give off income, and that's a great thing. They're paying good interest, and you can use that interest as income. And they're paying pretty decent interest, especially in this environment right now. So that's that is a great reason to have bonds. And there's another reason that people like bonds as well. Not only the interest and the income, but what else?
They don't go down so much when the market goes down. So
yeah, they're a lot
sometimes they
safer.
go up. Yeah.
Yeah. So, we can't have all our money at risk. We can't have all our money in the market. Sometimes we need some of our money where? Someplace safe.
Else.
Yeah, someplace safe. And bonds are safe, and they give off income. And I guess those are all good reasons to be invested in bonds. But I guess that's also what concerns me. And I guess as we look at this, it's important to know that bonds move opposite of interest rates. So let me show you what I mean by that. And I'd actually draw a diagram with a teeter-totter. I draw a triangle on a yellow pad with a line representing a teeter-totter on the triangle. So they have something to look at. So let me show you what I mean by that. It's like a teeter-totter with interest rates on one side and bond values on the other. So if interest rates go down, what happens to bond values?
Go up.
Yeah. And if interest rates go up, what happens to bond values?
Go down.
Yeah. In the financial world, that relationship between bond values and interest rates, it's kind of like a law of physics. It's always true. But sometimes it helps to understand why it always ends up being true. So would you like to see why it always works that way?
Sure, please.
Well, now I'm going to use the diagram. and we'll look at that here in a second. Let's say you had a $10,000 bond paying 5%. And you wanted to sell it because you just wanted the money to go on vacation or buy a car, whatever. You just want to sell it. So let's say you take your bond paying 5% to the imaginary bond store, and you put it on the shelf and you put a for sale sign on it. And let's say interest rates went down and the banks were offering 4% for their CDs or other fixed investments. And by the way, how would that be for a rate today, 4%? Would that be a good rate?
I'd take it.
Yeah, that would be a pretty good rate. But now if given the choice between a 5% or a 4% return, what will people choose every time?
5.
Yeah, 5%. I agree, and it's obvious why. I mean, why will they always choose 5? I agree with you. It's obvious that they will, but why will they always choose 5?
More is better.
Yeah, more is better. When it comes to our money, we're always trying to do the best that we can, and people are always looking for more, all other things being equal. So if someone came into the imaginary bond store with $10,000 looking to buy and saw your bond on the shelf paying 5 and knew the best that they could do at the bank was 4, they're going to want your bond, aren't they?
Sure.
Yeah, because it's a better rate. But let me ask you this. If the best they can get at the bank is 4 and you're offering 5, are you just going to ask for $10,000 same as the bank, or might you ask for what?
More.
Because you're giving more, right?
Sure.
So when interest rates go down, what happened to the value of your bond?
Went up.
Yeah, just like that teeter-totter we talked about just a little bit earlier, right?
Yep.
But let's say the situation's reversed. Let's say interest rates go up instead of down. And let's say the bank is offering 6% for their CD. Yours pays 5, the bank's pays 6. If someone walked into the imaginary bond store and saw your bond paying 5 and they knew they could get 6 at the bank, are they going to want your bond?
Nope.
No. They're not. Because they can get a better rate at the bank, right?
Yep.
Although if you think about it, they might be interested in your bond if you were willing to do what with the price?
Put the price down.
Yeah. So notice when interest rates go up, what happens to the value of the bond?
Goes down.
Yeah, just like that teeter-totter we looked at earlier. Does that make sense?
Mm-hmm.
So the question people start to wonder is this: how much would my bond go down if interest rates went up? And there's actually a pretty easy formula to calculate that, so would you like to see how you could figure that out?
Sure.
So guys, you can see the diagram there on your screen. This is the diagram right out of the proposal. So make sure you're using the proposal. So Eric, in our example, we said you had a $10,000 bond paying 5%. Okay, so how much interest are you earning? And the answer's right here, guys, so that you can point to it and they can see. So how much interest are you earning on $10,000 at 5% each year?
$500 a year.
Yep, right. So let's say interest rates went up from 5 to 6% like we talked about in our example. And like we said, if given the choice between a 5 or a 6, everyone would choose what?
6.
Yeah, they would never choose the 5 unless the seller was willing to do what with the price?
Put the price down.
Yeah. So what the buyer is going to do, or the potential buyer is going to do, is he's going to take the interest rate. He's going to take the interest in dollars, the $500 that he's going to get from your bond, and divide it by the new or the current higher interest rate. So now at this point, guys, I would give them a calculator and say, what's 500 divided by 0.06? And this is what it turns out to be. They'll see it on the calculator, but it's also here on the diagram. So what is that number there, Eric?
8,333.
Yeah. See, what that's really saying is if you gave the bank $8,333, at 6%, they'd give you back something that pays $500 a year in interest, just like yours. So if they can give the bank $8,300 and get something for $500, What's the most they're going to give you for your thing paying $500?
$8,300.
Yeah. But look what just happened here. Interest rates only went up how much?
1%.
But the value of your bond went from $10,000 down to what?
17%.
Yeah, that's a 17% drop in the value of that bond. And here's a question. Could interest rates go up by 1%, say, in the next 18 to 24 months?
Sure.
Yeah, they could. And when you think about it, where are interest rates right now? Are they high or low?
A lot
Yeah.
lower than 5.
A lot lower than 5, right? I mean, what's your savings account pay these days?
0.
Yeah. Well, then 0 is what a lot of people say. But it's paying something, but it's less than 1%. It's near 0, right?
Yep.
They're actually, interest rates, would it surprise you to hear that interest rates are actually at historic lows?
Yep.
So going forward, where do you think interest rates will go from here?
Got to go up.
Yeah, and when they do, what's going to happen to the value of any bonds or bond funds that you have?
It's going to go down by a lot.
Yeah. Just like you said, it could go down by a lot, because when we looked at our example, interest rates only went up 1%, but that $10,000 bond lost how much of its value?
It's almost 17%.
Yeah, $1,700 or 17%. And is a 17% drop in value a little drop or a lot?
It's a lot.
Yeah, I think so too. In fact, do you know of any other investments that can lose 17% of their value in a year, year and a half?
Stocks?
Yeah, I mean, we've seen that happen with stocks, haven't we?
Sure.
So I guess my question is, if bonds can lose just as much, just as fast, are they really any safer than stocks?
Nope.
No.
Not right now.
Now, if you owned individual bonds, you could hold them to maturity. And then you wouldn't have to worry as much about this fluctuation in interest rates, because bonds are like a loan. The borrower agrees to pay you interest every year, and at the end of the term, it might be 5 years, 10 years, 20 years, or if it's a long maturity, 30 years, they have to give you back all your money. So bond values will always go up and down with the change in interest rates. That's why you still get a statement every month when you invest in bonds. But that change in value really only affects you if you sell your bond before it matures. But here's the thing. You've got bond mutual funds. So do you own the individual bonds, or does the fund own them?
Fund owns them.
Yeah, so do you even have the option of holding the bonds to maturity?
No.
Now you might think the fund would, because they know too that when interest rates go up, the value of their fund is going to do what?
Go down.
Unless they hold the bonds to maturity. But here's the thing, if the value of the fund starts to fall, which it will because interest rates go up, will all of the tens of and thousands of the fund investors sit tight, or will some of them want to sell when they start losing money?
You gotta panic.
Yeah. And how does the fund get the money to pay back the people who want out?
Sell. Sell the assets.
Sell the assets, sell the bonds, right?
Yep.
So can they even hold them to maturity?
Nope.
So if interest rates go up, the value of these bond funds will do what?
Go down.
And eventually interest rates will have to do what?
Go up.
Which means the value of the bonds and the bond funds will do what?
Go down.
Yeah. Now guys, we can't stop there, because it isn't really about bonds. It's really about their advisor. So now I'm going to ask Eric, did anyone cover this with you when you were looking at the bonds?
Well, my guy showed me a seesaw once, but not recently.
And did he talk about all what could happen when interest rates went up?
Not in this detail.
Well, would it have made a difference?
Something I think I need to look at right now.
Yeah. I mean, would you want to at least have seen other options if you'd known all that?
Sure.
So why do you think this wasn't covered with you to begin with?
Maybe you didn't know.
Could be. Could be that he didn't know. Well, let's think about this. You said that at least it might have changed the way you looked at bonds had you known, and that you might have wanted to see some other things as well. And why would that matter to your broker? Why would he care if you wanted to look at things other than bonds?
That's what he makes, maybe?
Yeah, it might affect what he makes. I mean, here's the thing about bond commissions. Bonds are the only security where brokers aren't required to disclose their commissions. You know, they've tried to change that law for years. They've tried to force bond dealers to disclose their commissions on the sale of bonds, but guess who keeps lobbying against it?
The brokers.
Yeah, well, specifically the brokers that sell what?
Bonds.
Bonds.
Yeah. Because really, when you think about it, it shouldn't matter, because don't brokers have to disclose their commissions on mutual funds?
Mm-hmm.
Yeah. So why don't they want to disclose their commissions on bonds? Do you think they're embarrassed by how little they make?
Probably not.
Yeah. It's not because they make so little. I mean, thing is, if you were to walk down Wall Street and you saw a guy on the street with a $5,000 suit and a $500 pair of shoes, guess what? That's not a stockbroker. That's a bond broker. So why do you think none of this was covered with you?
Has to do with the money.
And when you say it has to do with the money, what do you mean by that?
The money that the broker's making.
Yeah. I mean,
Guys,
who's
keep
he
in
really
mind-
looking out?
And keep in mind that at this point, Jeff has covered how many other topics other than this where they were put in a worse position and the advisor is put in a better position. So by the time he gets to bonds, guess how...
Yeah. Remember, I said on the website this was part 12? So we've covered 11 other things up to this point.
So
So
Jeff,
by now,
yeah,
I'll go ahead and...
when Jeff is just barely touching these things, the guy is jumping to conclusions before Jeff even finishes his sentence. I mean, does Jeff have to convince them then that the guy is screwing them at this point? If after 12 items, every single thing puts them in a worse position and their advisor in a better position? Or is Eric actually going to be probably 2 steps ahead of Jeff as he's walking him through the motive to this?
This is the icing on the cake.
Yeah, that's what it is. You're exactly right, Michael. It's the icing on the cake. So I just want to say, because, when Jeff is doing this, when Jeff is isolating this, some of you, especially people who are guilty of selling bonds, guess what you're saying? I mean, it's not that big a deal. It's not that... And again, I am all for selling bonds. Guess what I'm for selling bonds?
When interest rates are going down.
Yeah, when interest rates are high. I mean, if I can get a bond at 10 or 12%, a AAA bond at 10 or 12%, will I be selling the heck out of bonds?
Heck yeah.
Because there's only one direction it could go. But you know what? Will I? Probably no. Because guess what I'm afraid of when bonds are selling have a 10 or 12% interest rate? Guess what I'm afraid of?
Your expectations of inflation could be 20%. So
Exactly. Exactly. So I'm going to be chicken to sell them when they're that high. But how many brokers out there now are selling bonds to unsuspecting clients, not telling them what Jeff has gone through with you guys? So I just wanted to, on an isolated scenario, this does not seem, I mean, I still think it seems very powerful. But boy, when it's the icing on the cake, it is like it is icing on the cake, the nail in the coffin. It is done with that advisor. Sorry, Jeff.
No. And so, yeah, again, bonds face some serious, serious headwinds. And if Warren Buffett and Bill Gross won't get into bonds, should we be putting people into bonds?
Nope.
Any questions? I know we're at the top of the hour, maybe just a little over.
There's no other questions that have come in.
All right, well then, Mike, I guess you're doing the
covering that. You did a fantastic job on that. And guys, this is you need to master this. You need to master this in this economy, because guess where everybody's put their money? Bonds. You're going to run into client after client after client after client has bonds. So guess how good you better be at this, Eric.
Very, very
Excellent.
good.
Yeah.
Yeah, Michael, you need to be very, very good. You should master this, because this is. But again, remember, it's about slaughtering the bond or pinning the motive to, did this guy cover this with you and why didn't he?
On the advisor. Yeah.
Yep. Motive. I'm the advisor. But that doesn't make it any less powerful to make them pee their pants when they see that this thing they thought was going to be safe, when interest rates go up 1%, could go down 17%. I mean, that's very powerful, but you cannot stop there, because what will they do if you stop there? They'll run back to the guy and say what?
Why didn't you tell me?
Why'd you tell me and do what? Get me out of this thing into something else.
Get me out of it. Yep.
And then who's out?
Oh, then we're out if they go right back
we're
to
out.
the advisor.
Yep. Yep. So, Michael, thank you. Eric, thank you for helping Jeff. And Jeff, thank you very, very much for putting this together. Guys, go over this backwards and forwards till you have it mastered, because this you're going to use this a lot in the upcoming months.
Yeah.
So, any questions for like people go, Mitzi?
Nope, that's everything that. Can we get the presentation? I'm assuming that's the bond presentation we just went through. We'll post it with the replay on the website, so you'll see the replay out on the website here in by the end of the day.
Yep, the guys go over that over and over and over till you've mastered, and then all of the charts and stuff that Jeff went over to show the client are actually in the proposal itself. So, thanks again, and thanks, Jeff, for doing that, and thank you, everybody, for being on the call today, and I hope you have a good week, and we will talk to you next Monday. Thanks, everybody.